In today's episode, I'll talk about three interesting stories. In the first one, I'll talk about how SEBI wants to kill scammy advisors and PMS managers. In the second story, I'll talk about how the Indian economy is doing. And in the third one, we'll talk about why the rice industry has been in the news lately and what it means for you and me. Welcome to yet another episode of the Daily Brief Show by Zerodha. I'm your host Anurag Bansal, and today is Wednesday, the 18th of September. By the way, a quick announcement before we start. We have recently taken all your feedback into consideration and started a new Hindi channel. Make sure you check it out if Hindi is the language of your preference. The link is in the description below. Now let's begin with today's stories. In June, SEBI proposed a new asset class aimed at addressing a gap in the current investment landscape. This proposal is designed for investors with capital between 10 and 50 lakh rupees, which is a segment that falls between traditional mutual funds and portfolio management services or PMS. Now, SEBI's primary concern here is the spread of unregistered and unauthorized investment schemes that target investors with a capital between 10 and 50 lakh rupees. These investors find themselves in a regulatory vacuum of sorts. They have outgrown the typical mutual fund offerings, but they don't yet meet the high entry barriers of portfolio management services or PMS, like I mentioned. Here, let me first break down the key aspects of the proposal. First, SEBI is suggesting a minimum investment threshold of 10 lakh rupees for this new asset class. This positions it as an intermediate option between mutual funds, which can be accessed with as little as 500 rupees, and PMS, which requires a minimum of 50 lakh rupees. Second, and perhaps more importantly, SEBI proposes allowing these funds to use derivatives not just for hedging but also for active market positioning. This opens doors to sophisticated strategies like long-short equity funds and inverse ETFs, which are common in hedge funds or AIFs or alternate investment funds. For your reference, currently mutual funds and PMSs can only use derivatives for hedging. So if a sophisticated investor wants derivative-based investment strategies, one has to invest in alternate investment funds or AIFs where the minimum investment is even higher at 1 crore rupees. Additionally, SEBI has proposed relaxing certain investment restrictions on this new asset class. These include higher limits for single issuer exposure in both equity and debt, increased sectoral limits, and more flexibility in REIT and InvIT investments. This proposal has also sparked some interest from the Association of Portfolio Managers in India, or APMI, which is an association of the largest PMS managers. According to a new article by Hindu Business Line, they have requested that SEBI consider allowing PMS managers to manage this new asset class as well. In the consultation paper that SEBI had published, only mutual funds are allowed to offer this new asset class. PMS managers are not allowed. But to understand APMI's position here, it is very important to know the background. In 2019, SEBI increased the minimum investment for PMS from 25 lakh rupees to 50 lakh rupees. Now, this change significantly impacted the PMS industry, especially smaller firms that were struggling to attract high net worth clients. For APMI and its members, managing this new asset class could provide access to a broader investor base, which reduces challenges posed by the higher PMS threshold. But SEBI appears to be favoring mutual fund houses to manage this new asset class, and they cite the existing infrastructure for handling daily transactions and a smooth experience with retail investors as the reason for it. But what SEBI finally decides is something we'll have to wait and watch on. But having said that, it is clear that this new asset class, if implemented, could offer investors access to more sophisticated strategies without the high entry barriers of traditional alternatives. Now, moving on to the second story of the day, let's talk about how the Indian economy is doing. The World Bank recently published its India Development Update, and it gives us a fairly detailed overview of the Indian economy. The entire Daily Brief team read it, so you don't have to, and I thought it'll be great to summarize all the key highlights for you. Let me start with the good news first. In the fiscal year 23-24, India's GDP grew by 8.2%, which outpaced other major economies. This growth is reflected in India's financial markets as well. Indian equity markets have hit new all-time highs this year, with the total market cap of India's stock market now at around 5 trillion US dollars. India's share in the MSCI Emerging Markets Index has also grown and has reached an all-time high of 20.5%. A key driver of India's growth is government investments. The central government has increased its capital expenditure by 28%, focusing on infrastructure development. Now, this push in infrastructure, which includes roads, ports, power plants, and improved logistics, is laying the groundwork for future economic growth. In the manufacturing sector, we've seen a significant rebound. After contraction of 2.2% in the previous year, manufacturing grew by 9.9% in FY 2023-24. This growth was supported by declining import costs, particularly due to moderation in global oil prices. The manufacturing expansion was primarily driven by sectors like construction and electronics, which benefited from both public infrastructure investments and the increasing domestic demand in the country. India's services sector, especially areas like IT and finance, continues to be a strong point for the economy. Services growth remained robust at 7.6% in FY 23-24, with modern services like IT and business services growing at about 13% annually since 2000. These sectors now account for over two-thirds of India's services exports. However, not every sector in India's economy is doing equally well. Agriculture, which remains crucial for rural livelihoods, has faced significant challenges. Agricultural growth fell to 1.4%, which is down from 4.7% in the previous year. This decline was primarily due to erratic rainfall, which shows how vulnerable this sector is to climate factors. But this year, monsoons are looking good so far, and the hope is that the growth will rebound. The agricultural slowdown has broader economic impacts, by the way. Private consumption, which drives about 60% of India's GDP, fell to 4% in FY 23-24 from 6.8% in the previous year. And this is partly attributable to the reduced rural incomes, which affect household spending eventually. But there was an uptick in consumption growth in the last quarter. What remains to be seen is if it was just a small blip or the start of a strong consumption rebound. But having said that, high-frequency data points like air travel, passenger vehicle sales, FMCG sales, cement consumption, etc. are indicating that rural consumption is slowing down while rural consumption is picking up. The net-net impact on consumption growth, however, still remains to be seen. On the inflation front, while headline inflation has moderated to an average of 5.4% in FY 23-24, food inflation remained high at 8.9% on average in Q1 FY 24-25 before dropping sharply to 5.4% in July 2024. Now, these fluctuations put pressure on household budgets, particularly for lower income families. Looking ahead, India's economic growth is projected to remain strong at 7% in FY 24-25 despite subdued external environments. Several factors contribute to this positive outlook, by the way. The significant expansion of public investments in recent years is expected to crowd in corporate investments. A recovery in agriculture and declining inflation should boost private consumption growth. Additionally, the services sector, particularly IT and business services, continues to show robust growth. But looking further ahead, India is expected to double its current annual GDP of $3.5 trillion to $7 trillion by 2030, which could potentially make it the world's third largest economy. This growth trajectory is very heavily supported by India's very favorable demographics. Our country's demographic dividend is expected to persist until at least 2055-2056 and peak around 2041 when the share of the working age population, which is 20 to 59 years, is expected to reach 59%. Moreover, the middle class is the fastest growing social segment, which is rising at 6.3% per annum since 1995 and is now representing around a third of the total population of the country. But there are still some challenges, particularly in job creation. Despite strong economic performance, the link between exports and employment has only weakened over time. The share of export-related jobs has decreased from 9.5% of total domestic employment in 2012 to 6.5% in 2020. Now, this paradox of high growth and lagging job creation is partly due to the nature of India's exports. I'll explain. India's exports have increasingly shifted towards more capital-intensive and skill-intensive sectors. While these sectors, such as IT services, pharmaceuticals, and advanced manufacturing, contribute significantly to the economic growth, they generate fewer jobs as compared to traditional labor-intensive industries. This shift explains why strong export growth has not translated into proportional employment gains in the country. The challenge for India is to diversify its export baskets to include more labor-intensive sectors. Industries such as textile, apparel, leather, and footwear have traditionally been significant job creators, especially for women and also for less skilled workers. However, India's global market share in these sectors has been declining. For instance, India's share in global exports of apparel, leathers, textile, and footwear or ALTF sectors peaked at 4.5% in 2013, but since then has declined to 3.5% in 2022. Now, this brings us to an important opportunity that emerges from global supply chain shifts. As China gradually withdraws from low-skill manufacturing due to rising wages, a significant market gap is opening up. Countries like Bangladesh and Vietnam have been very quick to capitalize on this opportunity. Bangladesh's share in global ALTF exports reached 5.1% in 2022, while Vietnam's rose to 5.9%. India definitely has potential to capture a much larger share of this market, which could boost both exports and jobs in the country. But in order to seize this opportunity, we need to address many challenges. And this includes our approach to trade policy. In recent years, India has increased its use of protectionist measures. The average most favored nation tariff has risen to 18.1% in 2022, up from 13.4% in 2016. Now, this trend is not unique to India alone. It is a part of a global resurgence in protectionism. In 2023, almost 3,000 new trade distorting measures were imposed globally, 3 times as many as 2019. However, India's protectionist measures, even though are aimed at protecting domestic industries, may be hindering its integration into global value chains. India's participation in global value chains has been declining over the past decade. Specifically, the use of imported inputs in India's exports has fallen from over 25% of gross exports around 2010 to about 15% in 2020. Now, this decline in the use of foreign inputs for exports limits opportunities for technology transfer, productivity improvements, and job creation in the export-oriented sectors. Despite this growth, India remains a largely underallocated market for major emerging market portfolio managers relative to other EM countries, which suggests a potential for increased foreign investments in the future. Now, to address these challenges and capitalize on emerging opportunities, India has to do many things at the same time. First, diversifying exports into more labor-intensive sectors while continuing to support high-value, skill-intensive industries. Second is reducing trade barriers, both tariff and non-tariff, in order to improve competitiveness and integration into global value chains. Third, focusing on skill development in order to prepare the workforce for both labor-intensive and high-skill jobs. Fourth, improving logistics and trade facilitation to reduce the cost of exports. Fifth, reevaluating trade agreements and regional integration options to expand market access. Now, considering how far we have already come, the hope is that India will get things right and will continue to grow at a healthy pace. Moving on to the third and the final story of the day, let's talk about why India's rice market is in the news lately and what it means for people like you and me. Rice is a staple on our plates. Given India's climate and agricultural conditions, we have over the years become one of the largest exporters as well as consumers of rice in the world. Talking about the basmati variant of rice specifically, India has over an 80% share in the global export market. Our basmati rice is specially loved in the Middle East, Europe, and in the US. In fact, just last year, we exported more than 5 million tons of basmati rice, which brought in close to $6 billion into our country. Because of the sheer scale of rice production and consumption in the country, one certain thing is that even a very small change in policy or market dynamics can seriously affect global markets which depend or deal with India. And that is exactly what is happening right now. Let me explain. Last year, lower rainfall and other climatic conditions significantly impacted rice production in India. This resulted in a reduced supply of rice in the markets, which eventually risked a significant rise in prices. So in July last year, the Indian government banned the export of non-basmati white rice in order to control domestic supply and also stabilize prices. The idea was to keep more rice within the country in order to meet our local needs before exporting it to the outside world. Now, even though this move had good intentions, it had some very bad damaging consequences. Rice exporters found a hack in order to deal with the export ban. They started mislabeling non-basmati rice as basmati rice. This way, cheaper varieties of rice started to slip through under the premium basmati label. This not only violated export norms but also distorted the overall market. The international markets were flooded with rice that was not really basmati, and the result was that prices both in India and abroad were disordered. So in October 2023, the government of India stepped in and reduced the minimum export price or the MEP for basmati rice from $1,200 per ton to $950 per ton in order to stop this mislabeling practice. To give you some context, MEP or the minimum export price is the lowest price set by the government at which a product can be exported out of India. The idea behind lowering it was to reduce the incentive for exporters to mislabel cheaper non-basmati rice as basmati rice. Recently, though, the government revised the MEP on rice once again and completely removed it this time around. The timing of the rice harvest season may have contributed to this decision. See, rice is typically harvested in India between the months of September and October, and if the country's supply chain of rice suddenly increases, prices are bound to fall very drastically. So, the decision to remove a minimum export price on basmati rice exports is probably because the government wants to avoid an oversupply situation, which could further complicate matters. Now, all of this is very important because price adjustments directly impact farmers, exporters, and even the average consumer. In an ideal world, exporters want lower barriers to stay competitive, farmers want a better price for their produce, and consumers like you and me want to buy food at the lowest possible prices. And while we are all bound to look at these things from our personal perspective, governments need to balance all kinds of needs and expectations and only then come up with a middle ground which helps the greater good. So it probably all makes sense. Now let's move on to the final section of the day, which is the small tidbits. First, Jindal Steel is integrating green hydrogen into steel production in Odisha, which is aiming to reduce carbon emissions. They plan a 4,500 ton annual capacity by 2025 and will supply 36,000 tons of oxygen to Angul Steelworks, which will position Jindal as a leader in sustainable steel. Second, Adani Enterprises and Wilmar International are selling 13% of Adani Wilmar worth 736 million US dollars in order to meet 25% public shareholding requirements. Currently, Adani and Wilmar jointly hold an 88% stake in the company and are required to bring this down to 75% by February in order to meet the minimum public shareholding requirement of 25%. Third, Samsung's Tamil Nadu facility is facing a strike over wages and working conditions right now. Workers want 36,000 rupees monthly over 3 years, which is up from the previous 25,000 rupees. And this could potentially impact Samsung's production as well as market share in India. That's all the news and stories I have for you today. I hope you found value in this episode. I'll see you tomorrow. Take care and goodbye.